Let's answer some common homebuyer questions. Should I get pre-approved for a mortgage? Yes. Getting pre-approved allows you to know exactly what you can afford, which helps you be prepared while searching for a home. It also helps buyers know that you're serious when you put down an offer. What upfront costs should I expect before closing? Common upfront costs include earnest money, an appraisal fee, and a home inspection report if you choose to have one. Your agent will help you negotiate with the seller for some of these costs. What is earnest money? Earnest money functions similarly to a security deposit. It is money in the form of a check that shows the seller that you're a serious buyer. The agent holds on to that money until closing, at which point the money goes towards your down payment or closing costs. What should I expect to put down for a down payment? Down payments typically range from 3% to 20% of the home price, but there are some programs that may allow no money down options, depending on certain qualifications. It's important to remember that the higher your down payment is, the lower your loan, and therefore your mortgage payments will be. There are many different loan programs, and your loan originator will help you determine what is best for you and your financial circumstance. When do I need the money for the down payment? While your mortgage is processing, you will need to provide documentation showing the funds are in your bank account. On closing day, you will wire the money from your bank account to pay your down payment, as well as any other prepaid or closing costs that are due to other parties. What are prepaids and closing costs? Closing costs are costs associated with the work that goes into obtaining a new mortgage. They may include things such as the transfer of real estate taxes, title fees, and attorney fees. Often the seller may pay for some or all of these costs depending on your purchase contract negotiations. Prepaids are expenses usually associated with the homeowner's insurance and setting up an escrow account. An escrow account, what's that? Most traditional mortgages require an escrow account. It is set up in order to pay homeowners' insurance premiums and property taxes for the life of your loan. Its balance grows as you make mortgage payments until specific bills are due. Then it automatically pays them for you. Keep in mind that the amount in your account and how much you contribute to it may fluctuate upon annual reviews. I've closed on my loan. When is my first mortgage payment due? After closing, your first payment is due a month after the last day of the month in which you closed. So for instance, if you closed any time in July from the 1st to the 31st, your first payment would be due September 1st. Closing earlier in the month requires more prepaid interest at closing, but allows you more time before your first payment is due. While closing later in the month shortens the time before your first payment, but lowers the amount of money you'll need for prepaid interest at closing. Still have more questions about how the mortgage process will work for you? Get in touch with a mortgage expert today.